Other than the results of tomorrow's US presidential election, the question that keeps coming up the most is what is going on with interest rates? It's as if the yield curve has become completely different curves, each one doing the opposite from the other. Now, the bond market had been rallying, expecting the Fed to cut. Then once the Fed does it, long-term rates completely reverse course and shoot higher? And if that wasn't confusing enough, short-term rates aren't just going lower, they're on the verge of plunging lower. How do we make any sense of this baffling mess? Now, some have claimed this is some kind of Trump trade. Others say suddenly deficits now matter again, the first stirrings of bond vigilantism. Then there are those who will always claim to the very end this is the market coming to grips with the Fed prematurely declaring victory over inflation, as if the Fed has anything to do with either of those. Nah, it's none of the above. This is the yield curve settling into recession. Yep, that's right. What the yield curve is doing right now is what it does in recessionary periods. It steepens out. This is the one part of the bull steepening that gets glossed over. Bull steepening is when rates go down, all of them, short, middle, and long parts of the curve. But they don't move lower at the same speeds, nor at exactly the same times and in the same ways. Each piece responds to information and developments differently, sometimes focusing on separate inputs. And one of those critical inputs is the degree of uncertainty. And it is different for each various curve section, and it changes at different intervals. Now, over time, the whole thing comes together, rates go down, and when they do, we all forget about how they did. This is not the first time this has happened, obviously, and there have been overall bull steepening processes that have seen sell-offs in long-term rates even larger than the one we're looking at right now. And I'll give you one example that sounds weirdly familiar to what we're facing right here in late 2024. Short-term rates that had turned lower in a hurry while the 10-year Treasury yield surged by more than 80 basis points in only a couple of months. And all of this took place during the first few months of an outright general recession. And even more confusing, long-term interest rates were going down while the payroll reports looked positive and solid. And then long-term interest rates turned around and went higher when the payroll reports turned negative. It's all about uncertainty and steepening. And that's certainly what we've seen in the current case here in October, November 2024, starting in September. In the middle of September, the 10-year U.S. Treasury hit 3.63%. That's its most recent low. That was the middle of September, a couple days before the Fed actually cut rates. Then as of Friday, after the recessionary payroll report, somehow the bond market sold off and the 10-year got up to 4.37%. Now, it's down a bit today, but that's a pretty substantial rise in interest rates, long-term interest rates, that seems very counterintuitive because the Fed started cutting rates, acknowledging the weakness, and now we're getting more and more confirmation around a whole bunch of macroeconomic data, especially the labor market, incomes, what I keep pointing out. And why are long-term rates suddenly going this much higher? It seems like it's outside of any historical norm, therefore it has to be some meaningful change in market position, but it's actually not. So you can see what's happened. The long-term treasuries over the last almost 2 months, 10-year goes up to 437. At the same time, the 3-month continues to go lower and lower. And the difference between those, the 3-month, 10-year calendar spread, that was 133 basis points inverted on September 16th, the low for the 10-year Treasury. As of Friday, that's down to just 38 basis points inverted, which means not quite bull steepening. The curve has to flatten out first before it bull steepens, but this is moving solidly in the direction of that bull steepening. 3-month is going down while the 10-year seems to be going up, and this is not abnormal at all. The dot-com recession began officially, according to the NBR, many months later in March of 2001. And oddly enough, that's where our story is today. That's where the comparison that we're going to make, that's when the comparison we're going to make took place. In March of 2001. To set the stage, payrolls had become weak heading into the year 2001 after a concerning finish to the year before. The dot-com bust was taking place, and it seemed to be taking a toll on the U.S. economy. So in early January, the Federal Reserve intermediating rate cut by 50 basis points, and a couple days later, The Bureau of Labor Statistics came out with a payroll report for the month of December 2000 that was just 105,000. At least it was on the positive. Plus, the unemployment rate was still 4% relatively. It was moving up a little bit through the second half of 2000, and into 2001, it seemed like it was going to continue to rise. A month later, the next payroll report, well, they revised December's number down to 19,000. And by the way, I'm going to use the contemporary reports from the BLS just so you get a sense of what everybody was thinking and seeing in terms of data and really the information that was coming in at the time as it was unfolding. So on February 2nd of 2001, the BLS reported, first of all, the revised December number that was just plus 19,000, which sounds pretty familiar to October. So we had a 19,000 that was down, but January's comes in at plus 268, at least the initial report. However, the unemployment rate moved up 0.2% to 4.2% because the household survey was doing something different. But either way, it looked like, okay, maybe the economy was steadying. But then in March 9th, the BLS comes out with more revisions to the January payroll report. They got that down to 224 from 268. And December was revised up a little bit to just plus 36. But again, some weakness. But February comes in at plus 135. At the same time, the unemployment rate is flat at 4.2%. So you don't necessarily get a solid idea from just those 3 months of where the economy's heading. It looks relatively weak, but it doesn't look like it's falling off a cliff, at least in these initial contemporary estimates. As I said, the Federal Reserve had cut rates by 50 basis points in January of 2001. They brought the federal funds rate down from target rate from 6.5% to 6%. Then on January 31st, they cut by 50 basis points more. And then on March 20th, a couple weeks after this payroll report, they've cut by 50 basis points again. So you would think that given the weakness that was apparent in the payroll reports, the fact that the Fed is aggressively cutting rates, and there's a whole bunch of other macroeconomic data that is at the very least looking concerning, bond market rates must be plunging lower, except they weren't. From the middle of March of 2001, over the next several months, the curve would absolutely split. There was a dichotomy, a divergence in the various ends of the yield curve. And that wasn't the only thing. One reason why there was such a divergence is that the Bush administration, the brand new Bush administration, was beginning to act on a campaign promise to enact substantial tax cuts. On March 9th of 2001, according to the Washington Post, the House voted narrowly yesterday for an across-the-board reduction in Americans' income taxes, giving President Bush his first legislative victory on the centerpiece of his tax cut program, but exposing bitter partisan divisions that could hamper final approval of the $1.6 trillion package. The bill, which was approved by a vote of 230 to 198, would cut income tax rates and shrink the number of tax brackets from 5 to 4. Over 10 years, it would reduce government revenue by nearly $1 trillion, with a retroactive provision providing $5.6 billion of tax relief in the current fiscal year. This was called EGTRA, or the Economic Growth and Tax Relief Reconciliation Act, and it was signed into law in early June of 2001. So as March of 2001 was developing, you've got Fed rate cuts, aggressive rate cuts, and you've got the federal government promising major, massive stimulus in the form of not just these tax cuts, there were other provisions as well. The entire federal government apparatus seemed like it was responding to major economic weakness with its own big bazookas. At the same time all of that was going on, quite a few people thought that this was an overreaction by the part of the Fed. This was an overreaction, or it was a partisan matter on the part of the federal government. The economy was not all that weak. In fact, it was showing signs, as we saw in the payroll reports, of perhaps some unappreciated strength. On the same day as that Washington Post article talking about the tax cuts, in Time magazine, the following was written. This is March 9th of 2001. It looks like the recession that wasn't. Not with unemployment rate holding steady at 4.2%. The Department of Labor reported Friday that people were still working in large numbers in February, earning more with average hourly earnings back on the grow after a flat January, and working more, with the non-farm payroll up 135,000 jobs for the short month. People are working and they're earning more money. This sounds really familiar, especially in the aftermath of the September 2024 payroll, which everybody said this is a strong, resilient economy. Continuing with Time. It's an indication that they're going to spend, meaning consumers, in the months ahead, despite what sentiments the consumer confidence numbers have been indicating. The economy has slowed down, and we're probably going to see 1 to 2% for the first quarter of this year, but the momentum is for more growth rather than less. Sound familiar? With consumer spending, the inventory correction will probably be finished in the next month or two, at which point production will have to go back up on its own. The worst is over, Time magazine declared on March 9th of 2001. And that sentiment was not a unique one. It was widely shared amongst certainly most economists, because economists are always very optimistic, especially when you get government action. This particular economist was more in love with what was happening from the Federal Reserve, the aggressive series of rate cuts. Remember, the maestro Alan Greenspan at the time had a huge reputation. His reputation at that particular moment was at its absolute peak. So economists were relatively sanguine about economic prospects in 2001, in large part because the economy seemed to be holding up, despite the fact that the dot-com bust was already by then a year old. Back one more time to our economist here. My guess is that they'll cut rates on March when I talk about the Fed, but just by 25 basis points, because they don't want to overstimulate. These cuts are going to have the greatest impact 6 or 9 months down the road, which could be the same time the economy really picks back up. Again, sounds really familiar. My long-term guess is that the Fed will end up having to take that quarter point back near the end of the year, higher for longer in 2001. And it seemed like the bond market, was actually agreeing with this economist. Because from right around then, a couple weeks afterward, the 10-year U.S. Treasury began a sell-off that lasted, it seemed to be a pretty substantial one and a meaningful change, and it would end up lasting 2 whole months and take the 10-year Treasury yield up 81 basis points from that low. You've got the long end and you've also got the short end. And the future path of short-term interest rates to the short end seemed to be less uncertain, because the more the economy showed signs of trouble, the more likely that was going to lead Greenspan's Feds to cut more, which they did. That economist was wrong. The Fed cut by another 50, and of course there were no rate hikes at the end of 2001. There were only more rate cuts for another couple years that eventually brought the federal funds target down all the way to 1%. But how do we explain the 10-year Treasury going at the other direction? And the answer is bull steepening. And bull steepening with a high degree of uncertainty that was introduced by a couple of things, including the bond market rally that preceded all of this. To start with, the 10-year had rallied from late October of 2000 all the way to March of 2001. It had gone from 5.9% to 4.73%. So you're talking about roughly 120 basis point reduction in long-term interest rates. So that's a huge rally in a relatively, historically speaking, short amount of time. So even though the economy looked questionable and it looked like it was heading toward recession, the degree of uncertainty after that initial rally was indeed large. The long end of the marketplace wanted confirmation of a whole bunch of different things that weren't just necessarily about the actual recession itself. High degree of uncertainty at the long end, or a higher degree of uncertainty introduced at the longer end that was not there at the shorter end. The shorter end, the Treasury bills and to some extent the notes eventually, especially after a couple months, started to price more and more recession, and the curve itself steepened out, bull steepening in classic fashion. And the funny thing was that payrolls did the exact opposite as you would expect too. As I said in the introduction as well, you had positive payrolls that were kind of questionable, but they looked kind of solid as interest rates, the long end and the front end, were both going down. And then once the payrolls turned negative, as they would for March, April, and May, that's when rates were going up. And so the market seemed to behave contrary to what we would expect, at least in the short run, from information coming in that payrolls are declining and short-term rates are going down because the Fed's cutting rates. You would think that would inspire even more of a rally at the long end. But no, it actually went in the other direction. And as I said, by more than 80 basis points across 2 months. The curves seemed to be two different curves during the first several months of what was later declared as the dot-com recession. As I always say, nothing goes in a straight line, and that includes bull steepening into a recession. Bull steepening takes place, and it's not just that all interest rates go down at the same time. And we have a number of different examples of this. March of 2001 was maybe one of the best ones that is closest an example to what we're seeing today. But there have been many others. During the cycle before, 1990-91's S&L recession. We even saw this to a degree in September and October of 2019, the last rate cut cycle that we were in before today. Now, we don't know how that one would have turned out. I believe everything was pointing toward a recession. I mean, some countries around the world actually did say there was a recession, Japan being an example. However, the yield curve behavior was classic bull steepening, classic recession type of behavior, including how in September and October of 2019, it seemed like we got two different curves once again. The 3-month Treasury bill rate had been around 2.4% around May of 2019. It dropped to 2% by the middle of September as the Fed started cutting rates. And then it would continue to go lower, down to 1.5% by November of 2019. At the same time, from early September of 2019 through the repo rumble and everything else, the 10-year Treasury rate backed up from around 1.47% to 190. So you got bull steepening there too, where the long end of the curve is rising at the same time the short end is falling. Now again, we don't know what would have happened, but that was absolutely consistent with recession in the yield curve, even though it doesn't seem like it, at least in the short run. So again, a lot of this has to do with uncertainty. So after big moves in the bond market, like any other market, you see this consolidation phase where market participants want to see confirmation or they want to see refutation that what started the rally to begin with, that moved interest rates lower, is actually happening. If we believe the economy is weak and heading into recession, can we get confirmation of it before the next leg in the rally develops? Nothing ever goes in a straight line. Same thing with bull steepening. Bull steepening goes in different phases and parts as well. So where the short end of the yield curve has less uncertainty about how the Fed's going to respond to weakness, because the Fed in these cases likes to err on the side of caution, more rate cuts than not. So the 3-month Treasury bill, the short end of the yield curve, has less uncertainty, as during this initial phase, the long end has more uncertainty. But eventually, the highest probability reality usually ends up winning the day. In fact, it does in every single case. Once you get into the bull steepening after the inversion, that's the recession. Though nobody has the ability to say for certain, especially in short run periods, we got to wait for the NBER maybe a year from now to finally say we're in recession. By then it's too late. So essentially we don't have that type of clarity. Uncertainty is always a factor. Nothing goes in a straight line, but what we're seeing is nothing more than the classic steepening of the yield curve heading into recession. While the October payroll report wasn't definitive proof of the recession case, it showed that it wasn't really about October at all. It's every bit consistent with an economy and labor market heading toward recession. Went over the details in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.